Most people think that when markets crash, money disappears. History shows the opposite. Money does not disappear. It changes hands. In every major crisis, 13th century Venice, 17th century England, Meiji-era Japan, the United States after 2008, a small group emerged wealthier than before. Not because they predicted the exact day of collapse, but because they understood the structure of capital redistribution. A crisis is not a random event. It is a moment when the system is redesigned. And during redesign, those with liquidity, those with access to the right financial instruments, those who understand credit cycles are able to buy assets at discounted prices that others are forced to sell. In 2009, when the S&P 500 lost more than 50% from its peak, most investors pulled money out. But funds with available cash and access to cheap borrowing bought in. Over the next 10 years, it became one of the strongest wealth expansion cycles in modern history. So the question is not, will there be a crash in 2026? The question is, if the credit cycle reverses, will you be the one forced to sell or the one positioned to buy? Because in every period of financial stress, the rules of the game do not disappear. They become clearer. And in this video, we are not talking about fear. We are analyzing what mechanisms create millionaires during system restructurings. And more importantly, how to position yourself correctly when capital flows begin to shift. So what truly creates wealth during a crisis? Not luck, not predicting the exact day the market falls, but three structural conditions that appear before every major cycle of capital redistribution. Condition 1. Liquidity before everyone else needs it. In every crisis, the rarest asset is not property. It is cash. When markets panic, people do not sell because they want to. They sell because they must. Margin calls, negative cash flow, debt maturities, fund redemptions. During 2008 to 2009, commercial real estate was sold below book value across multiple markets, not because buildings disappeared, but because owners no longer had the liquidity to hold them. This pattern is older than modern finance. In 17th century England, land changed hands after credit contractions. After the Asian financial crisis, industrial assets moved from over-leveraged conglomerates to those with stronger balance sheets. When credit tightens, assets do not evaporate. They transfer, and the transfer follows a simple rule. Those with cash or access to cheap credit gain optionality. Those without liquidity lose optionality. They have obligations instead. Optionality is power. Obligation is vulnerability. That is why the first strategic move is not finding the best stock. It is building a liquidity buffer large enough to survive 12 to 24 months of volatility without being forced to sell. Forced selling is where wealth leaks out of the system. Avoiding forced selling is where strategic advantage begins. Liquidity is not about earning a return. It is about buying time. And in every restructuring cycle, time is the asset that separates sellers from buyers. Condition 2. Understand the structure of the credit cycle. Financial crises do not begin with bad headlines. They begin with leverage. When credit expands too quickly for too many years, asset prices often rise faster than real productivity. Cheap money amplifies risk-taking. Debt feels harmless. Cash flow looks permanent. Then something shifts. The cost of capital rises. Liquidity tightens. Refinancing becomes harder. And the system begins to adjust. You saw it in the dot-com cycle around 2000. Valuations detached from earnings, fueled by abundant capital and optimism. You saw it in housing 2008. Mortgage leverage layered on top of securitized leverage. You saw it across emerging market booms. Foreign capital flows in fast. Currency mismatches build quietly. Then tightening reverses everything. Even the recent crypto cycle followed the same architecture: easy liquidity, leverage through derivatives, then forced deleveraging when prices dropped. Different assets, same structure. The people who made the most were not those who perfectly called the top. They were the ones who recognized when systemic leverage was stretched and adjusted positioning early. Right now, global public and corporate debt sit near historical highs. That fact alone does not guarantee a crisis, but it does mean one structural reality. If credit conditions tighten, highly leveraged assets feel pressure first, because debt does not shrink when revenue slows. Obligations stay fixed, and when refinancing windows close, even good assets can be forced into distressed pricing. So the practical strategy is not paranoia. It is structure. Reduce personal leverage. Avoid assets that depend entirely on short-term borrowed capital. Favor assets supported by real, recurring cash flow. Leverage is a multiplier. In expansion, it accelerates gains. In contraction, it accelerates destruction. Understanding that asymmetry is not about predicting collapse. It is about recognizing where fragility accumulates before the cycle turns. Condition 3. Buy productive assets when pricing becomes distorted. In a crisis, markets do not discriminate carefully. They sell broadly. Strong companies and weak companies fall together. Prime real estate and secondary properties feel pressure at the same time. Healthy businesses and fragile ones are repriced in the same wave. Panic is not analytical. It is mechanical. In 2009, many companies with solid balance sheets, stable cash flow, and durable business models were trading at single-digit price-to-earnings ratios. The businesses did not suddenly become worthless. Liquidity disappeared. Confidence collapsed. Funds faced redemptions. So prices detached from intrinsic value. Who bought during that window? Not retail investors acting out of fear. Long-term capital with patience and cash reserves stepped in. Crisis periods are moments when price separates from value. And that gap between what something is worth and what the market is willing to pay in panic is where structural wealth is built. But recognizing the gap is not enough. To act, you need 3 things: liquidity, discipline, and the psychological capacity to tolerate temporary volatility, because buying when others are forced to sell never feels comfortable. The headlines are negative. The chart is falling. The future looks uncertain. Yet structurally, this is when productive assets, businesses generating real cash flow, infrastructure, essential services can be acquired at discounts that do not appear in stable environments. A crisis compresses time. Years of expected returns can be front-loaded into a narrow window of mispricing, but only for those prepared before the window opens. This is not about heroism. It is about positioning. Wealth in restructuring cycles is rarely created by speed. It is created by structure meeting opportunity at the right moment. Now look forward. If 2026 or any coming year brings a sharp correction cycle, it will not create millionaires from people who guessed headlines correctly. It will create millionaires from people who are not forced to sell, have cash when others don't, understand which assets have real productivity, and can hold positions long enough for recovery cycles to unfold. Crises do not reward the smartest. They reward the prepared, and preparation does not mean exiting markets entirely. It means building a portfolio structure that can survive before trying to win big. So now we move to the most important part of this entire strategy. Not predicting crashes, not hunting for a secret stock, but constructing the right portfolio architecture for stress cycles. If you look at large institutional investors, pension funds, endowments, Family offices, they do not invest emotionally. They classify assets by function, and in environments where volatility risk is elevated, three strategic asset roles consistently appear. First, stability and liquidity assets. These are not designed to maximize return. They are designed to preserve optionality. Cash equivalents. Short duration instruments. Highly liquid positions that can be deployed quickly. Their job is survival and flexibility. Second, productive cash flow assets. Businesses generating recurring income, infrastructure. Essential services. Assets tied to real economic output. These respond to inflation differently than static capital. They can adjust pricing. They can defend margins over time. They are not immune to drawdowns, but they possess economic engines. Third, asymmetric growth exposures. This is where long-term upside lives. Innovation, technological transformation, structural shifts, higher volatility, higher uncertainty, but also higher convexity. Institutions balance these three roles deliberately because in stress cycles, concentration in only one role creates fragility. Too much growth without liquidity, you become a forced seller. Too much liquidity without productivity, you lose purchasing power over time. Too much leverage on cash flow assets, you amplify downside. Portfolio construction is not about predicting the future. It is about ensuring your structure can withstand multiple futures. In the next layer of strategy, we go deeper. How to classify your current holdings into these three buckets. How to rebalance gradually before volatility arrives, not during it. Because when markets shake, the window for structural adjustment closes fast. And in finance, the advantage rarely goes to the fastest reactor. It goes to the one who positioned early, quietly, before the cycle turned. Defensive capital. Capital for survival. This bucket is not built to impress anyone. It is not built for headline returns. It is built to survive. Defensive capital includes strategic cash reserves, high-quality short-term government bonds, highly liquid instruments, low volatility assets. Its role is not growth. Its role is time. When markets drop 30 to 40%, the investor with strong defensive capital is not forced to sell productive assets at a discount. More importantly, they gain optionality. Optionality is power. In every major drawdown, the constraint is not intelligence. It is liquidity. Most individual investors fail structurally because they allocate nearly 100% to growth assets during expansion cycles. When momentum is positive, that feels rational. When liquidity tightens, that structure becomes fragile. If your entire portfolio depends on continued optimism, a downturn removes flexibility. You are no longer choosing, you are reacting. Defensive capital prevents forced liquidation. It absorbs volatility so your long-term assets do not have to. Institutions understand this deeply. Endowments and pension funds do not chase maximum returns in every environment. They preserve enough dry powder to act when pricing disconnects from value. Cash, in expansion cycles, looks inefficient. In contraction cycles, it becomes strategic leverage without debt. That is the paradox. Defensive capital is boring during bull markets. But in crisis periods, it is authority. Because survival is not passive. It is a competitive advantage. Productive assets, real cash flow engines. This is the core of long-term growth. Not assets that rise because liquidity is abundant. Assets that rise because they produce. Examples: businesses with durable, recurring cash flow, income-generating real estate, companies with sustainable competitive advantages, infrastructure, energy, essential services. The common thread is simple: they are tied to real economic output. When inflation appears, they can adjust pricing. When growth slows, they often retain baseline demand. People still need electricity, still need food distribution, still need logistics, healthcare, communication across long historical cycles. Assets linked to real productivity have preserved and compounded purchasing power better than idle cash or purely nominal claims. Cash is a tool. Productive assets are engines. But here is the critical nuance. In short-term crises, productive assets still get sold. During liquidity events, markets do not pause to separate strong from weak. They liquidate broadly. Good companies fall with bad ones. High-quality properties fall with speculative ones. Because in panic, the driver is balance sheet pressure, not valuation logic. And that moment when productive value trades below intrinsic worth is where the third strategic group becomes decisive. Because growth is not only about owning productive assets, it is about knowing when mispricing turns temporary fear into structural opportunity. Opportunistic capital. Capital for strategic deployment. This is the smallest bucket, but it is the one that creates step change wealth. Opportunistic capital does not work in calm markets. It activates under stress. It requires liquidity ready to deploy. Emotional tolerance for volatility. Valuation discipline. When assets are sold below intrinsic value because of systemic pressure, not because their core productivity disappeared, opportunistic capital steps in. This is not random buying. It is structured positioning. You act when systemic leverage is being flushed out. Strong businesses are mispriced due to forced selling. The credit cycle is near the end of a tightening phase. 2009 offered blue-chip companies at valuations not seen in decades. 2020 saw entire sectors priced as if demand would permanently vanish, even when fundamentals suggested temporary disruption. In every major cycle, the largest asymmetric opportunities appear when fear peaks and liquidity is scarce. But opportunity is useless without structure. If all your capital is tied up in growth assets, you cannot deploy. If all your capital is in defensive reserves, you lack compounding engines. If you use excessive leverage, you are eliminated before opportunity arrives. Opportunistic capital only works when it is supported by the first two buckets: defensive capital that preserves survival, productive assets that sustain long-term growth. Crisis wealth is not created by prediction. It is created by positioning before stress. When fear spikes, most people focus on headlines. Those with structure focus on pricing. And pricing dislocations, when met with liquidity and discipline, are the moments where portfolios shift from surviving to advancing. Now ask the only question that really matters. If 2026 or any coming phase brings a deep correction, which bucket dominates your portfolio? 100% growth, no defensive layer, no liquidity buffer, or have you built a three-tier structure: defense to survive, production to compound, opportunity to accelerate? Crises do not mint millionaires from recklessness. They reward structure that existed before stress arrived. You do not need to predict the exact date of a downturn. You only need to prepare so that if it comes, you have advantage instead of vulnerability. And now we arrive at a factor most investors underestimate but which determines survival more than asset selection, personal leverage, and cycle endurance. Because many investors do not lose good assets due to misjudging value. They lose them because of debt structure. It is not the asset you own that determines how long you survive. It is the obligation you must service. A great business with stable cash flow can survive volatility. A great property can survive price swings. But if you carry short-term floating rate debt and refinancing windows close, the timeline compresses. Markets can stay irrational longer than you expect. Credit conditions can remain tight longer than comfort allows. Leverage shortens your survival horizon. And in financial cycles, time horizon is everything. Low debt extends your optionality. High debt converts volatility into existential risk. This is why institutions obsess over duration matching. Refinancing schedules. Covenant flexibility. Because cycle endurance is structural. The investor who can hold through 2 years of stress will outlast the investor who must liquidate in 6 months. In the next layer, we go deeper. How to evaluate your personal leverage exposure. How to structure debt so it does not become a forced sell trigger. And how to increase your financial runway before volatility tests it. Because ultimately, wealth is not built by the asset that grows fastest. It is built by the structure that survives longest in every major U.S. market crisis 2000, 2008, 2021 pattern repeats. Good assets are sold not because they are bad. They are sold because the owner cannot hold. Margin calls. Failed refinancing. Negative cash flow when rates rise. Debt is not the enemy. Mistimed debt is the accelerant. During prolonged low-rate environments, leverage feels rational. Cheap money creates the illusion of safety. Monthly payments look manageable. Asset prices trend upward. But when the cycle turns, cost of capital rises, liquidity tightens. Risk premiums expand, borrowers feel pressure first. The structure is simple. If you borrow short-term to fund long-term assets, you are dependent on refinancing. If you apply high leverage to volatile assets, you are dependent on markets not falling too far. And markets always have the capacity to fall further than comfort suggests. In the recent tightening cycle, many high-growth companies without profitability saw valuations compress dramatically as funding costs increased. At the same time, companies with strong balance sheets, low debt, and positive free cash flow proved far more resilient. The difference was not the vision. It was the capital structure. In financial systems, fragility hides in obligations. Revenue fluctuates. Valuations fluctuate. But debt schedules do not fluctuate on your behalf. If your fixed obligations exceed your flexibility, volatility becomes existential. This is why seasoned capital allocators ask a different question before asking about upside. How long can this structure survive under stress? Survival horizon matters more than projected return. Because in cycles of contraction, time becomes the scarce asset, and the investor who extends their time horizon outlasts the one chasing maximum upside with maximum leverage. The lesson is not avoid debt. The lesson is align debt with durability. Match duration. Avoid dependence on short-term refinancing. Ensure cash flow covers obligations under conservative scenarios. In other words, it is not the asset's potential that determines endurance. It is the structure wrapped around it. And in every cycle reset, those who misunderstood that distinction were forced to exit early, while those who respected it remained positioned for recovery. If you want to survive a stress cycle, there are 3 questions you must answer with brutal clarity. First, if my income drops by 30% for 12 months, will I be forced to sell assets? Second, if interest rates rise another 1 to 2%, can my debt structure absorb it? Third, if markets fall 40%, do I still have liquidity to wait for recovery? Institutional investors run stress tests routinely. They model downside scenarios before they model upside returns. Individual investors rarely do, and that difference is structural. Because markets do not eliminate people who were wrong. They eliminate people who could not endure. A portfolio that looks strong in expansion can collapse under pressure if obligations are rigid and liquidity is thin. Stress testing is not pessimism. It is structural awareness. Imagine your financial life as an aircraft. You do not test the engine only in clear skies. You test it under turbulence, crosswinds, system failure simulations. The question is not whether turbulence will come. It always comes. The question is whether your structure can handle it. When income falls, do expenses flex? When rates rise, does your debt adjust safely? When valuations drop, can you hold without panic? Survival is mathematics, not motivation. Cash flow coverage, debt duration alignment, liquidity runway. The investor who survives the storm is automatically positioned for the next expansion. The one who exits at the bottom misses the compounding that follows. This is why stress testing separates participants from long-term capital allocators. And here is the uncomfortable truth. Most portfolios are optimized for return, not resilience. But resilience is what allows return to compound over decades instead of resetting every cycle. In finance, longevity is leverage of a different kind, and those who stay in the game long enough benefit from the most powerful force in markets, time combined with structure, and then there is the more subtle factor, psychology. In every crisis, markets do not fall in straight lines. They move in waves, sharp drops, violent rebounds, another leg down, another rally that feels like the bottom. Volatility is not just price movement. It is emotional whiplash. Investors without a pre-built plan get pulled into the oscillation. They sell after sustained pain. They buy after relief rallies. They repeat the cycle. Loss is not only financial, it becomes behavioral. This is where structure does something most people underestimate. It protects psychology. When you know you have a defensive layer, panic loses intensity. When you know you have liquidity reserved for opportunity, drawdowns look different. You stop seeing only threat. You begin seeing optionality. This shift is profound because markets test conviction through discomfort. If your entire net worth swings violently, your nervous system reacts before your logic does. Cortisol rise. Decision quality drops. Time horizon collapses. But when your portfolio is structured in tiers defense, production, opportunity volatility becomes segmented. Not everything is under pressure at once. You have breathing room. And breathing room changes behavior. Instead of reacting to headlines, you refer to your structure. Instead of asking, "Should I sell?" you ask, "Which bucket does this belong to?" Instead of chasing rebounds, you wait for valuation alignment. The greatest hidden cost of poor structure is not lost return. It is emotional exhaustion. Investors who burn out psychologically exit markets permanently. They miss recoveries not because they lacked intelligence, but because they lacked resilience. And resilience is engineered before stress arrives. A well-designed portfolio is not only a financial instrument, it is a psychological stabilizer. When you understand your layers, you interpret volatility differently. Fear becomes data. Drawdown becomes context. Recovery becomes probability, not hope. This is why institutional frameworks outperform individual impulse. Not because institutions feel less fear, but because they design systems that reduce its impact. In markets, clarity under pressure is rare. Structure is what makes it possible. Now, let's go one layer deeper. In every major U.S. stress cycle, something else always happens. The rules change. Regulation tightens. Accounting standards shift. Capital requirements increase. Weaker participants are removed. After 2008, the U.S. banking system was fundamentally reshaped. Higher capital ratios, stricter supervision, stress testing became institutionalized. Banks that were sufficiently capitalized survived. Weaker ones disappeared or were absorbed. And what followed consolidation? Greater scale concentration, stronger balance sheets at the top. History shows a recurring pattern. After every purge cycle, the strong become structurally stronger. Why? Because crisis reduces competition. Over-leveraged players exit. Fragile business models collapse. Access to capital becomes selective. Survivors inherit market share. This dynamic is not limited to banking. After the dot-com collapse, the speculative layer vanished. But companies with durable business models dominated the next decade. After 2020, firms with digital infrastructure and pricing power accelerated, while weaker peers faded. Stress is not only destructive, it is selective. It reallocates advantage. So here's the strategic implication. If you allocate capital to assets capable of surviving industry restructuring, you do not merely endure the downturn, you benefit from the cleansing. You gain exposure not just to recovery, but to post-crisis dominance. This is a structural lens most investors ignore. They ask, will this company survive? The better question is, if the industry contracts by 30%, who gains share, survival is baseline? Structural advantage after consolidation is where long-term outperformance compounds. Crises compress time. Years of competitive sorting happen in months. And when the dust settles, the landscape is different. Fewer competitors, higher barriers to entry, greater pricing power for survivors. If your capital is positioned in entities that can endure regulation, shifts, absorb tightening conditions, and emerge with stronger competitive moats, you are not just protecting wealth, you are aligning with the natural consolidation force that follows every stress cycle. Markets do not simply crash and recover. They restructure, and those who understand that restructuring dynamic invest not only for rebound, but for concentration of strength afterward. So the real strategy is not, how do I avoid ever facing a crisis? The real strategy is, how do I make crisis an accelerator for me instead of a destroyer? That requires liquidity discipline, rational debt structure, assets with real productivity, and patience. There is no fast-track formula to get rich during crisis. But there is a formula to avoid being wiped out. And once you are not wiped out, you retain the right to participate in recovery. And recovery phases are where the largest wealth expansions occur. Now, let's connect everything into one final strategic point. Not to predict which year collapses, not to manufacture fear, but to understand a simple truth about the U.S. financial system. It is not designed to be fair during crisis. It is designed to reallocate capital structurally. And that structure consistently favors three groups: those with liquidity, those with access to credit, those with time. Liquidity gives you optionality. Credit access gives you leverage, but controlled leverage, not desperation. Time allows compounding to resume after volatility passes. During stress cycles, assets transfer from impatient hands to patient balance sheets, from over-leveraged structures to well-capitalized ones, from short time horizons to long ones. This is not conspiracy. It is architecture. Financial systems reward durability. If you must sell because you need cash, you are a liquidity provider to someone else. If you can wait, you become the accumulator. If you can borrow when others cannot, you become the consolidator. Every major wealth shift in modern U.S. history, from post-depression industrial expansion to post-2008 equity compounding to post-2020 sector consolidation, followed this pattern. The crisis is the stress test. The recovery is the multiplier. So the strategic question becomes, are you structurally positioned to be a forced seller or a patient accumulator? Because markets do not punish ignorance. They punish fragility. And they reward resilience. In the end, wealth during volatile cycles is not created by superior prediction. It is created by superior structure meeting inevitable stress. And when you understand that, you stop asking, when will the crash happen? You start asking, am I built to benefit when volatility arrives? That is why after every stress cycle, asset concentration often increases rather than decreases. After 2008, the largest financial institutions became even larger. After COVID, technology companies with strong balance sheets expanded market share aggressively. After every cleansing phase, those with resilient structure absorb what remains. This is not random injustice. It is capital dynamics. Capital flows towards stability. And when risk rises, stability becomes scarce. Scarcity attracts capital. Now look at the current you. Yes. Market structure. 3 characteristics stand out. First, overall debt levels are significantly higher than in previous decades. Second, financial assets make up a larger share of household net worth than ever before. Third, market valuations are deeply intertwined with central bank liquidity conditions. This does not automatically mean the system will break, but it does mean one thing. If the credit cycle tightens meaningfully, volatility will transmit more broadly, and when volatility spreads, linear growth assumptions break. Investors who assume perpetual expansion without structural buffers face pressure first. Those who have built layered structures operate differently. They do not rush to exit markets. They adjust within markets. Adjustment is strategic, not reactive. Take a practical example. If interest rates remain elevated longer than expected, high-growth assets with weak or negative cash flow face compression. Not because innovation disappears, but because discounted future cash flows are worth less when the discount rate rises. At the same time, cash flow generating businesses with pricing power may experience margin pressure, but they retain operating leverage. In prolonged high-rate environments, capital becomes selective. Funding shifts toward profitability and durability. Speculative capital retreats. This is not a prediction. It is structural mathematics. When liquidity contracts, fragility is exposed. When liquidity expands, fragility is masked. The investors positioned with diversified tiers, defensive capital for flexibility, productive assets for compounding. Opportunistic reserves for mispricing do not depend on a single macro outcome. They depend on adaptability. In cycles where credit stress intensifies, concentration increases. Stronger firms consolidate. Well-capitalized investors accumulate. That pattern has repeated for centuries. The key insight is simple. You do not need the system to collapse to benefit from structure. You only need the system to change, because it always does. And those who prepare for non-linear outcomes are rarely the ones forced into non-linear losses. In financial markets, survival plus adaptability equals asymmetric advantage. And asymmetric advantage, compounded across cycles, is how long-term wealth is built. Businesses with strong free cash flow and low debt do something different in crisis. They do not defend. They expand. They repurchase shares at compressed valuations. They acquire weaker competitors. They consolidate fragmented markets. Crisis is not only about buying cheap assets. It is about reshaping industry power. That is where real accumulation happens. So if you ask, will 2026 create new millionaires? The answer is simple. Only for those who built structure before 2026 Millionaires in crisis are not born from bravery. They are born from preparation. They were not forced sellers. They had capital. They had patience. They understood that price and value often diverge under stress. In the coming phase, the key question is not which stock will outperform. The real question is, can you survive long enough for the cycle to turn? Is your structure flexible enough to adjust? Do you have liquidity available when panic creates mispricing? If the answer is yes, crisis is not a threat. It is repositioning. When you view markets structurally instead of emotionally, you stop asking, when will it crash? You start asking, if the system adjusts, where am I positioned in the capital flow? That is the question of a serious investor. Because in finance, advantage does not belong to the one who predicts the future perfectly. It belongs to the one who understands structure before most people even realize structure matters. If this framework helped you see market cycles strategically instead of emotionally, consider supporting the channel. And if you want to go deeper into how that's financial architecture truly operates, from public debt dynamics to credit cycles to liquidity, power, stay with us. In markets, prediction is loud, structure is quiet, and quiet advantages compound the longest.